We provide managed services basically for the whole of your IT and telephony infrastructure. It's almost easier to say what we don't do. We don't sell loads of mobile phones, but we do put apps on them. So everything from how you connect your business to the outside world, inside unified comms, how you connect all your devices together, how we connect your IT into the cloud, how we remotely look after your desktops. We've got an incredibly impressive customer list. I mean, a third of the business is public sector, 2/3 is commercial. So let's just do public sector for a minute. Some names you might know: Houses of Parliament, part of the Cabinet Office, 3,500 schools, over 100 councils, 20-odd universities, hundreds of colleges, some very big central government departments, but also some pretty famous names in the commercial world like Coca-Cola, Asos, Citrix, Marston's Brewery, Sotheby's, Talk Sports if you're a sports fan, there's loads of them, and thousands of small businesses as well. Right from day one in 2003, this business has typically had 7 to 8 percentage points higher EBITDA than anybody else of our equivalent size. So at the point when everybody else was 11, 12, 13, we were 18, 19, 20. So we've been knocking on the 20 to 21% EBITDA. So that tells you two things. First bit, we sell at sensible margins. Across the group, the average is in the 40s, and you've got to keep your OPEX around about 20 to 25. Right, so that's really about having good systems and automation in your back office. Now, what you mustn't do then is take all that profitability and spend it all in CapEx, otherwise you end up with no cash on a perpetual basis. So one of our basic rules is we run the business on what I call twos. We try and keep dividend cover above 2. We're well north of that, so we know dividends are sustainable. We try and keep our debt sensible, so we want our EBITDA net debt ratio under 2 as fast as we can. But in terms of CapEx, we want it well under 2. So we're averaging around about 1% of CapEx. So EBITDA is the best measure for us because it gives you the best idea of the cash that we're generating. At the end of the day, if you come right out to the detail, there's almost 1,000 companies on AIM. And there's only 3 that's managed earnings per share growth every year for a decade. That just shows you how hard in any sector it is to do consecutive growth. That's why our share price has increased so much, because of the sheer predictability of what we do. One of the ways that we try and guarantee as much as we can the predictability of what's happening is 75 to 80% of our revenues are on a recurring subscription type basis. You know, people who pay every month for what we do. That's where the growth has got to be. Now, we can't help the fact that if we do projects, we have to sell some kit. You know, if we take on your IT, we might have to upgrade your servers before we'll agree to support them. But that's only a way of getting to the recurring revenue. What you can expect from us is largely more of the same. We have a long history of both organic growth and acquisitive growth. What we are very good at is finding business privately. We buy private businesses, not public ones, paying sensible prices that works for both of us, but then improving the profitability of what we do. Now, it's taken us 15 years to get from nothing to best part of 100 million market cap. If we're going to take that journey to the next 200, then that'll have to be a combination of organic growth and further acquisitions. One of the ways that we manage the risk, because let's be honest, we are an acquisition vehicle. We've done 27, we can't pretend we're not, okay? It's almost as important the ones that we don't buy as the ones that we do. So one of the reasons why we don't buy a lot of people is if there is too much customer concentration in 1 or 2 big customers, then that's risky if they leave. So we've developed a business where if any individual 1 or 2 left, it doesn't hurt us a great deal, and that's quite key. I get asked about liquidity quite often, okay, and it's pretty normal on AIM where the original shareholders own a substantial chunk. If you go out in the market, there is a limit to what you can buy. If you want to buy more than 5 or 10,000 shares at one time, you might find it difficult. When you've taken the share price from 30p to £3.60 in the last decade, please don't be surprised if there's quite a few people who are sat on a lot of paper money, right? And therefore, if anybody wants a larger stake, then it's a couple of phone calls from the chairman, and normally people release substantial stakes. I mean, if you look at the family shareholding, we've gone down from something like 29% to 18% in recent times. So if you've got a serious offer, give me a ring and we'll find you somebody who's sat on a big paper profit.